Welcome to Signal and Clue, the channel where we cut through the noise and find what actually matters for your money. Today we're talking about something that most investors are watching with one eye, the Iran war. And more specifically, what happens to your portfolio when it ends? Because here's the thing, most financial channels will wait until the deal is signed to tell you what happened. We're going to walk through the scenarios now, so you're already positioned when the headlines hit. In this video, we're going to cover 4 possible scenarios for how this war ends, which sectors win and which sectors lose in each one, and then the scenario I think is most likely, and the hidden signals smart investors will be watching beneath the surface. Let's get into it. To think about this clearly, we need 2 variables. First, pressure level. How urgently do both sides need this war to end? Are they exhausted and desperate, high pressure? Or is this a slow negotiation where both sides still have leverage, low pressure? Second, deal conditions. Who walks away with the better outcome? Does Iran get a favorable deal, or does the US and its allies come out ahead? Cross those 2 variables, and you get 4 distinct scenarios, each with very different consequences for markets. Scenario 1. Low pressure and Iran favorable deal. This is the slow burn outcome. Neither side is desperate, but Iran manages to negotiate from a position of surprising strength, perhaps because oil prices are elevated and the global economy needs Iranian supply. Winners. Oil importers like airlines and shipping companies benefit as some sanctions get lifted slowly. Emerging market ETFs with Middle East exposure start to stir. Losers. U.S. defense stocks lose their urgency premium. U.S. energy producers, who benefited from elevated oil prices, face more competition. Safe haven assets like gold drift lower. Market reaction muted. This drags out. Investors price in uncertainty, not resolution. Scenario 2. Low pressure and U.S. favorable deal. A slow negotiation, but the U.S. and its allies come out clearly on top. Think of this as the controlled diplomatic win. No urgency, no desperation, just methodical leverage applied over time. Winners. Tech and consumer discretionary stocks benefit as global risk sentiment improves gradually. Financials gain as credit markets loosen. The broad market edges upward. Losers. Defense stocks. Moderately. Gold loses its safe haven bid. This scenario actually produces the most orderly market rotation. Market reaction, steady grind higher. No fireworks, but a reliable trend. Scenario 3. High pressure and Iran favorable deal. This one is the most volatile for markets. Both sides are under enormous pressure to end the war quickly, but Iran somehow secures surprisingly favorable terms. Maybe because the US faces domestic political limits, or because a regional actor steps in to mediate. Winners. Energy infrastructure plays and emerging markets with exposure to a reopening Iran. Nuclear energy, paradoxically, could benefit if Iran's nuclear program gets constrained in ways that reduce global supply. Losers. Defense stocks get hit hard, USD-denominated assets weaken, and Israeli tech stocks could face a volatile reaction if the deal feels like a loss for US allies in the region. Market reaction, volatile and sentiment-driven, initial relief rally, then a sharp reassessment. Scenario 4. High pressure and US favorable deal. And here's the one we've been building toward, the scenario that markets want most, and the one I think is most likely. Both sides are under intense pressure. Iran's economy is severely strained. Their proxy network, the Houthis, Hezbollah, has been significantly weakened. The US has real diplomatic leverage, and domestically, Washington needs a foreign policy win. This combination drives a fast resolution, and the US comes out clearly ahead on paper. Winners. This is the broadest market rally scenario. Tech surges, banks and financials open up. Consumer discretionary bounces as household sentiment improves. Airlines and shipping jump on falling oil prices and an open Strait of Hormuz. Losers. Defense stocks sell off. Gold gives up its risk premium. Oil producers face headwinds. Market reaction. Sharp initial rally. Strong and fast. This is the risk-on moment markets have been waiting for. My take, scenario 4, is most likely. So which scenario do I think we're actually heading toward? Scenario 4. High pressure, US favorable deal. Here's my reasoning. Iran's economy is under severe strain from years of sanctions. The regional proxies that gave Iran strategic depth have been degraded. The US holds more negotiating leverage right now than at any point in the past decade, and both sides have political reasons to want this resolved. The pressure is real on both sides, which means the resolution, when it comes, will likely be fast, and fast resolutions are what markets love most. If you're positioning for this scenario, the playbook is clear. Watch tech, financials, airlines, and emerging market ETFs for early movement, and start reducing overweight positions in defense and gold. Signals to watch, read between the lines. But here's where it gets interesting, and where most investors miss the real trade. The headline will say, US wins, markets will rally, and that rally will be real, at first. But I want you to watch for something beneath the surface, because I believe this deal, even if it looks US favorable publicly, will contain quiet concessions to Iran that aren't in the press release. Here's what I mean. When you're under high pressure and you need a deal fast, you give something away. You just don't advertise it. So watch for these 5 signals. Signal 1. Sanctions relief sequencing. If Iran gets broad, immediate sanctions relief, rather than phased relief tied to compliance milestones, that tells you Iran got more than the headline suggests. Watch oil markets in the 72 hours after any deal announcement. Signal 2. What each side says to its own audience. Watch what US officials say on CNN versus what Iranian state media reports to their domestic audience. If there's a significant gap between the two narratives, Iran got something real that wasn't announced publicly. Signal 3. Israel's public reaction. If Israel is notably quiet, lukewarm, or diplomatically vague about the deal, that's a signal. Israel's silence often means they're not happy. And if they're not happy, Iran likely got more than the US is admitting. Signal 4. Iranian crude export volumes. Track Iranian oil export data in the weeks following any agreement. If exports surge quickly, faster than the official timeline suggests, sanctions relief was more generous than advertised. This is a lagging but highly reliable signal. Signal 5. Gold and defense stocks behavior. After the deal is announced, if gold and defense stocks don't fall as much as you'd expect, the market is pricing in residual risk. It's telling you that investors don't fully believe the deal holds, or that the concessions were larger than the headline. The bottom line, the initial rally is real, but the durability of that rally depends on which scenario actually played out beneath the surface. These 5 signals will tell you which one it was. That's the framework. 4 scenarios, clear winners and losers in each one, my best read on where we're headed, and the signals to watch when the headlines break. If you found this useful, subscribe to Signal and Clue. We do this kind of analysis every week, cutting through the geopolitical noise to find what actually moves your portfolio. And drop a comment below. Which scenario do you think is most likely? I read every comment. This video is for educational purposes only and does not constitute financial advice. Always do your own research before investing. Thanks for watching, and I'll see you in the next one.